The reason 95% of new traders never become successful is because of this, the trading approach. When you skip one of the steps out of this, the whole trading approach falls apart and ends your trading journey. Your trading success depends on following the 4 crucial steps. Every step is dependent on each other and prevents you from losing. By the end of this video, many of you will realize that your trading growth has been stagnant because you have only been focusing on one step of the approach. That is to find the best trading strategy with the highest win rate. Well, the best trading strategy means different things to different people. The trading strategy is a must, but it is the last step. And before that, you need to make sure 3 important things. If there is one factor that can drastically improve your win ratio, it is timing. Take a look at this MACD chart. Ideally, you should be entering a long position here, right as the MACD crosses. However, if you enter the trade later on, you might still see some profit, but it wouldn't be 1-to-2 ratio. Now watch this. If you had entered the trade at the right time, this would have been easily more than 1-to-2 ratio. Think of the market like the ocean, the waves representing price movement. To ride waves successfully, you have to catch it at just right moment. Too early, you will get wiped out. Too late, you will miss the ride. Same goes with the trading. So what should you do in this situation? Simply let it go and wait for the next opportunity to show up itself, just like this one on the same chart. So when you're not disciplined with entries, you end up making the next big mistake, which is emotional trading. It is a force that pushes you to take bigger risks, to chase after more profits, and to keep going even when you already won some trades. Let's say you recently hit 1-to-2 win a solid trade, but instead of sticking to your overall approach, greed kicks in. You decide to increase your exposure, thinking that the price is bound to go in your favor again. But the market has the way of humbling you. It takes sudden turn due to any reason and your trade turns into a loss. That is where the trouble begins. You start to lose money, but it is not the money, you are actually losing control. The emotions take over, and instead of stepping back from the trading, you dive in again, trying to get back what you lost by increasing position size or revenge trading, which often ends up wiping your account. However, if you carefully apply the next step, which is to set up the bias, then the chances of winning trade gets better. The market only moves in 2 directions, up or down. Your job as a trader is to increase the probability of being on the right side of the movement. For example, in scalping, a trading strategy where you are in and out of the trades within the minutes. The goal is to quickly capitalize on small price movements, but what if you had a clue about the future direction of the market? That is where the bias comes in. The bias actually helps you to make a better entry decision. One way to gather clues is by looking at a bigger time frame like 1-hour chart and mark the key levels of support and resistance. If there is a nearby resistance or support level, then entering a trade on 1 or 5 minutes chart by following the trend will not give you positive results. This is where your bias helps preventing you from making impulsive decisions in sideways or uncertain market. Which brings us to the 4th step, the best trading strategy. Once we understand 3 important aspects of trade entry, it is time to use a strategy by keeping tight risk management, meaning that you should not risk more than 1% at any given trade. The strategy I'm about to show you is beginner friendly. So head over to TradingView's indicator tab and search exponential moving average and add this one to your chart. Then go to its settings and under the inputs tab, change its length to 200. And then under the style tab, make it wide and make it slightly thicker. Now we're gonna add another indicator. So go to indicators tab and search RSI. You can add either relative strength index or RSI divergence. Whichever you like you can have, as both the indicators are same. I'm gonna leave RSI on the chart and delete the other one. After adding that, go to its settings and under the style tab, scroll down to RSI middle band. Now make it slightly visible by changing its opacity or changing it. Now the RSI is ready. However, there is this yellow line which is a moving average, RSI based moving average. We don't use it in our strategy, so I'm gonna go ahead and disable it. The strategy is simple. On a 5-minute chart, when the price is above 200 EMA and the purple RSI line is above its middle band, we're gonna be entering only long position based on engulfing candle. Engulfing candle is something which is bigger than the previous candle's body and its wick. To find engulfing candle, we can make life easier by adding a helping indicator. So go to TradingView's indicator tab and search engulfing candle and add this one to your chart. So this is how it's gonna work out. The price is above EMA and the RSI line is also above the middle band. Press the green arrow shows bullish engulfing bar. So we're gonna be entering long here with the 1:2 ratio by putting the stop loss below the recent swing low. And once you discipline yourself with the emotions, timing and clear bias with proper risk management, you will see a big improvement in your strategies. You also need to practice this on many different pairs. Here's a second example to go long. However, in order to understand short entries, everything will be vice versa, meaning that the price needs to be below the 200 EMA as well as the RSI line needs to be below the middle band. Plus this time, instead of green engulfing arrow, you should be focusing on red engulfing arrow. Here's the thing, you can easily increase your win ratio by using Heikin-Nash candles. Watch this video to apply this on your chart.